This is NBR Today. According to a World Economic Forum study published this week, cyber attacks are ranked as the top risk for doing business in North America, Europe, East Asia and the Pacific. Globally, cyber attacks ranked 5th, up from 8th in last year's survey. New Zealand ranks them 2nd after extreme weather events. The financial system globally suffers an estimated US $1 trillion of cyber losses annually, and the rate of breaches against it has tripled over the past 5 years. Cyber analysts are predicting the next catastrophic financial collapse could be the result of criminal activity gone horribly wrong, rather than an intentional act, and say the financial industry in particular is not taking the threat seriously enough. They say there needs to be a united action from the financial industry and governments to crack down on the criminals involved before a big breach happens. Reliable rail services and regional growth have boosted Mainfreight's New Zealand performance as the company posted increasing revenues across all 5 of its regions today. Shares in the logistics operator rose on the news, up to $29.95 off an opening price of $29.20, having risen about 25% over the year. New Zealand revenues increased 8.3% over the same period last year. Mainfreight's local revenues had been hit by damage to rail lines after the Kaikoura earthquakes, and domestic freight volumes are at record levels. Global revenue came in at $1.43 billion from $1.23 for the same period last year, while net profit for the year came in at $55.7 million, a 28.2% increase. Group Managing Director Don Braid says he expects the solid results to continue in the next 6 months, with likely strong freight revenue in all markets in the run-up to Christmas.
We would certainly like America, Europe and Asia to paddle a little faster, but certainly in this result they've shown that we do have momentum. We are growing revenue very well, and we've improved EBITDA returns. So it's a good result across the full business.
Local authorities have warned the government not to impose a new system on them for supplying drinking water. One option in the government's Three Waters review is to take the supply of drinking water out of the hands of local authorities and give it to larger aggregated water suppliers. But local government New Zealand opposes the idea of mandatory aggregation of water services. Its president, Dunedin Mayor Dave Cull, says that does not mean aggregation will not happen, but it should not be forced on councils. Overseas experience reveals that in half the cases, aggregation works and regions benefit from economies of scale, but in the other cases, it hasn't succeeded. Mr Cull says regulatory standards should be created with local authorities required to meet them.
So what we're saying is put the regulatory standards in place, set a standards, require local government, who are the suppliers of fresh water, drinking water, to meet those standards, give them a time frame, and they may very well, in some cases, go for aggregation. They may get together with the surrounding councils and say, look, the economies of scale are here, we can pool our capacity and we'll achieve that. But if what we're saying is, if government says, right, the whole country is going to be split up into 3, 4, however many aggregated authorities, you're going to get perverse outcomes.
A takeover of wind energy company Tilt Renewables is dragging on in the face of opposition from its independent directors as joint bidders Infratil and Mercury extend their offer to November 30. The offer of $2.30 a share was due to close on Tuesday, but was extended for the final time as the bidders reached 84.4% ownership, still short of the 90% compulsory acquisition level, but high enough to make holdouts think twice about continuing as a minority shareholder. Before the takeover, Infratil and Mercury effectively controlled a combined 77.8% of Tilt, comprising Infratil's 51% plus Mercury's 20%, and its option on 6.8% owned by Tauranga Energy Consumer Trust. Tilt's independent directors, led by Fiona Oliver, have maintained their rejection of the offer, saying it's undervalued and recommended shareholders not accept. Chapman Tripp says increasing investor interest and rapid advances in markets are creating the right conditions for a growth surge in impact investment in New Zealand. The law firm released a report today into impact investing, which aims to generate social and environmental benefits as well as financial return. It encompasses green bonds, social enterprise, ethical funds management, and strategic philanthropy. The Global Impact Investing Network estimates the worldwide asset value of impact investments is $228 billion, of which $35.5 billion was committed last year. Social and environmental impacts are harder to measure than financial returns, but increasingly sophisticated tools are being developed to do this. Impact investing is relatively underdeveloped in New Zealand compared to similar countries, but Chapman Tripp expects this gap to narrow in part due to consumer demand. NBR's Grant Walker spoke to Chapman Tripp's finance partner, Ross Pennington.
It's growing because of investor impetus. We're now starting to tangibly see the effects of climate change and of generally, sagging infrastructure and those sorts of things. Those require an enormous amount of capital to fix them. And investors are telling the funds, the pension funds and so forth, that they want to see not just a good financial return, but where possible, also a positive social and economic return on their assets as well.
And to tomorrow, a large, potentially costly and probably risky 5-year LINZ project received cabinet approval this month. Columnist Rob O'Neill says this sets a test for agile development. So for more on that and other stories, head to our website and have a great evening.
To unlock your 2 free articles a week, head to nbr.co.nz.